Well, good morning, everybody, and welcome to the 11th annual Financial Tactics Breakfast. It's hard to believe that this is the 11th year. I think most of the panelists today are probably relieved this is here because they're tired of updating their presentation with all the changes going on right now, with all the stuff that Congress is doing. But thank you for being here this morning. The run of show is all 5 speakers are going to do a 20-minute presentation. We're going to take a small break, and then after that, we are going to do a Q&A session, which you will hopefully be a major part of. This is the most advanced estate planning session that we do throughout the year, and it's always very interesting to have all these panelists in one spot at one time, so you never get the sense that you're getting passed on. Ask your attorney, ask your CPA. You've got everybody in one spot. So this has become a much-loved event. I love it every year. I always learn a ton. So with that, we are going to start with Bruce Norris, CEO of the Norris Group, hard money lender, real estate educator, and real estate investor. My pops. Welcome, Dad.
Good morning, everybody. Make sure I get the lay of the land here. This is an interesting chart. So what we're going to take a look at is the price history of California, some of the things that make this price move up and down, and the charts that tell you that this chart may be changing directions. When I looked at this chart, I realized that I entered the real estate market 1974 when the median price was $34,000. We're now in excess of $800,000, which is a multiple of 24 times, 2,400%. That was astonishing to me. One of the nice things about California is it mostly goes up, and sometimes it goes up a lot. And so the last 2 years have been astonishing. We basically have gone from $600,000 to over $800,000. And at the end of this little talk, we're going to talk about the likelihood of that being difficult to continue going forward. When I first got into real estate, 74, we bought a house, and I checked this morning, from 1974 to 1980, California real estate prices went up an average of 19% a year for 6 years. And at the time, I thought I was a real estate genius because everything I touched went up, but you couldn't have helped it. And then we hit 1980, and real estate slowed. So we had our first pause in my lifetime for real estate. And then it went up, and then it calmed down at 1990 and had about a 5-year stretch there where it actually went down some for the first time in my lifetime. Then it boomed up until 2006, and then 2008, 9, it crashed. So it's very interesting that these cycles are so volatile in California sometimes. And so what's important is to realize that what's likely to come next, because we're going to hit a number next year that historically says, okay, the next 2 years after that is pretty volatile. So what happens normally in California during a cycle is you have 4 boom years of sales. So you can look back at the 3 cycles before this, and you have 4 years of extraordinary sales, and this time we didn't. In 2009, we had a boom year, but we gave people $8,000 to buy a house that was already at half price. So we induced them to buy something, and then pretty much for the whole duration until 2020, sales have been flat. 2020 was a little bit bigger, and but now, is that the first of the next boom? Maybe 3 more years? It's doubtful. And so part of what we're going to talk about is why that occurs. Unsold inventory right now, you can see history. You have explosion in inventory for sale, and then it goes down. And we are now at one of the lowest levels ever. So right now, if you try to buy a home, you're going to have multiple offers. And sometimes the prices, I just talked to an investor yesterday. He had a smile on his face because he flipped a house in San Diego, and it went for $200,000 more than asking price. So, ouch. That's not ouch for him, but just amazing. That's what's going on. So unsold inventory is very low, but then it has a chance that it goes up a lot, and it goes up quickly. So what causes that, and is it repetitive? New construction, very different this cycle. So normally we have building booms that go up until right to the end of a price boom. So most houses were built in this cycle at 89, 2005. We haven't had a building boom this time. There's a few reasons for that, but that's going to provide some benefits that we'll talk about later. But just to give you an example of how many homes were not built, we normally average, say for 10 years after the bottom of a market is hit, we average 110,000 new homes constructed. And for this last 10 years, we've averaged 45,000. That's an extremely different number of new homes. So that'll have some ramifications when we talk at the end of this discussion about what's next for California. Trustee sales are very volatile. When they decide to go up, they go up 1,000% in the first round in the 80s, 1,000% in the 90s, many thousands of percent, and now we're at the bottom again. So when you're at the bottom of the trustee sale pile, what happens is that you have no competition to sell against. There's no lender-owned property that's discounted. Everybody that owns a property is a private person, and in this market, you put some flowers in, you might get 100 grand more, and it's not even kidding. And so trustee sales, though, get tipped over by other charts. They don't invent themselves. And so there's a sequence that goes on. And we're at the bottom, and it'll be very interesting to see what happens for the next 3 years as far as the direction of that foreclosure chart, because it does dictate what happens to prices. Unemployment rate history, we were at the very lowest during the last years of the Trump administration, and we had the coronavirus. We've been working our way back down. We have a phenomenon where we have a lot of people that are just not working and tons of job openings. So this is a very unusual chart in that it kind of got interrupted by a pandemic. California affordability. So this is a chart that's historically very important for California. We have a history of touching a number that's 17% at the bottom. We hit it in 80, 89, 2005. Very likely to hit it next year. So with price increases and interest rate hikes, we'll probably hit 17%. So there's a sequence that happens after that. We'll talk about that in just a little while. What's interesting about affordability is it's definitely misunderstood. The California Association of Realtors has a statement on their website: affordability is equal to real estate well-being, which means the higher affordability, the better real estate well-being. And then when you look at the chart, you'll take a look at the years, say 2009, 10, 11, and 12, where prices went down by over 50%. That doesn't represent real estate well-being to me. It means that more people can afford it. But real estate well-being is when prices go up and affordability goes down. So the affordability is just a math function. So what happens is affordability goes down. So less people can technically afford it, but sales explode, constructions explode, prices explode, and they continue to do so because there's a human element in buying. And so that's why you have no inventory for sale in 2021. There's so many people that want it, even though the price is accelerated, and this is normal. So now when we hit 17% affordability, there's a natural ending point, and there's a sequence. So this is the median price. This is one of the charts that we use to say, okay, what happens when California is double the national median price? And so what starts to happen is people move out. This is a chart from 2018, and it shows that California lost 190,000 people migrating to elsewhere. Now in the last 2 years, that's over 500,000. So when you have California be twice the median price of the nation, people decide to leave. And how you can price that out is take a look at cost of U-Haul. I just used city. LA to Phoenix is $1,483. Phoenix to LA is $243. That's about the same distance, right? Just a multiple of over 10 times more. And Florida has the advantage too when you have New York going to Florida. So you can see where the direction of people are moving to. So here's the thing about hitting 17% affordability, and all of these charts all of a sudden make a turn for the worse. So there's a sequence that happens. Affordability, 17 hits, and if you're in an honest lending environment, And I say that because we went down to 12% affordability in, say, 2006, but it was a completely artificial lending environment. So normally when you get to 17% affordability, people want it. Everybody wants the houses, but they get told no by a lender. So you just don't qualify. So that's going to start happening more and more. And when that happens, all of a sudden, there are charts that start to change. And so we're right now at 23% affordability in California. And we're probably going to, if there's interest rates change, price that continues to go up, we'll probably reach 17%. And then the sales chart typically goes down by a lot. So you don't want to get surprised by that. Unsold inventory. So unfortunately, CAR doesn't have actual records that I can find going back beyond the first chart, but it was much lower and went exploded. And then the same thing happened after 89 and after 2006, where inventory exploded. And not only did it change in the amount of homes for sale, it changed in the type of inventory there was. And so that's one of the things that's very interesting about trying to figure out what's the most important chart that tells you you're going to have an impact on price. So in the 80s, if I told you from 80 to 82, your interest rates were about 15%, your unemployment was 10%, and foreclosures went up by 1,000%, give me your estimate about what would be the price damage in that time frame. The actual answer is there was none. Then you go into the 90s, and the interest rates were less. The unemployment rate wasn't 10, it was 8. All the charts were better, and yet we had about a 20% price hit over the course of 6 years. Then you go to 2007, 8, 9, 10, and we had a 50% decline in price, and interest rates were 6% or less. Unemployment was 10. We had better charts, but we had devastating results. So what was the difference? The difference was how many foreclosures were in the inventory. If the unsold inventory was made up of mostly individual sellers, as in 1980, 81, 82, then when you had an REO sell, it wasn't the comp that dominated the appraisal world. The appraiser could say, you know what, that's 1 in 4 sales, I'm not going to worry about it. In the 90s, it was 40% of the sales. In 2009, it was 75%. And it was the comp that mattered. And so it's really important to ask yourself what's going to go next. Are we going to have a rash of foreclosures, or are they going to somehow contain that this time? New construction crashes, very typically. Builders are the worst timing experts ever, to be honest with you, because their information happens in real time. They have an open house in 2005, it gets inundated with buyers, and all of a sudden it doesn't. And so it falls off a cliff. This time we don't have a cliff to fall off of. And that's very significant, because what happens when you build too many houses and no one wants them, you put them into auction and they sell for less than the person that lives there bought them for, and that causes a chain reaction of people to say, well, I'm not even going to keep it. So this time we don't have that problem. But new construction, which is already down, it could go down as well. The trustee sales react very quickly, normally. So again, you have to take a look at it and say, okay, well, what are the odds that we're going to have tons of foreclosures this time? So that'll be a policy decision. And how much willingness is there to foreclose on a bunch of people? So the sequence basically goes like this. You hit 17% affordability and sales slow. Inventory builds and prices start to stall. They may not go down, but they may. If they go down a lot, then all of a sudden you have foreclosures that increase, and that becomes a bigger and bigger mix of the inventory. Building usually slows, unemployment goes up. All the charts following 17% affordability in California the next 2 years are not pleasant. And so if we hit 17% affordability next year, which is a mathematical likelihood, we have to be careful about what we do in the next 2 years and see how things go. The biggest problem for California is that this price chart that we've enjoyed was also on the back of interest rates falling from 17% to 2.5% during that journey. So when you think about the likelihood of affordability getting built back in, and that's what always happens. So you can see you had 17% affordability, it built itself back in, but the next cycle, how's it going to get built back in if interest rates go up? If inflation is taking, all the prices of everything up and interest rates have to react, all of a sudden it's an impediment to affordability. So the three elements of affordability are the price of the property, the earnings of the people, and the interest rate. And all of a sudden, one of the big things that has been a big factor that built in affordability from the start of 1980 all the way down for 40 years, every time we hit 17% affordability, interest rates were our friend, went down, and built it back in. Well, now you have to rely on earnings to go up or prices to go down. So it's one of those math equations that's probably not going to change. 17% affordability is a bottom in a natural market. So going forward, if you start bouncing at 17 and all of a sudden interest rates go up to 5, it's a mathematical certainty that affordability will then not be at 17, it'll be less, and there'll be a price reaction in the marketplace. And we'll just have to see what happens to interest rates. We have a fourth quarter report that's coming out in November, or December rather, and we'll talk about the likelihood of inflation changing real estate interest rates up considerably, or if in fact that's not going to be a big factor. There's some things in place that are huge that are protections. So we have kind of changed our debt patterns. Since the Great Recession, people have become more conservative. So the prices have gone up a lot. If you've owned a property since 2009, it's exploded in value, but you probably didn't refi it every other year or twice a year. What's interesting is we have some people in the tax world I can talk to, and one of the habits in 2006 and 5 and 4 were refining the house every year and pulling out and buying toys or whatever they did. That wasn't true this time. People were more conservative and they paid down debt, and everybody has a fixed rate loan in place, and so it's just a very much safer market going forward than it was in the time that we had a big crash. But the biggest problem is that we are going to face a 17% affordability without the assistance of interest rates going down, and maybe the chart reverses and goes up for a long time. So California has enjoyed having big population gains from the 70s and 80s, and then we had the interest rates go down for 40 years, and the next 5 or 10 could be very different. And so that's one thing, just be cautious as a California investor that you think everything's going to be fine and that the momentum will continue. That's why I like charts. It takes me out of the emotion of the moment. I can make rational decisions and say, okay, what happened the last time we saw this? And it was different each time. So once again, in the 80s when we hit 17% affordability, the foreclosure ratio was only 25%. It didn't impact price. In the 90s, it was 40%. And it impacted price gradually every year for 5 or 6 years. And in 2009, you know what happened. It crashed and became 75% of the market. And what that basically did, it made the comp that counted the REO sale. So we would buy a house that was $360,000 3 years ago. We'd buy it for $65,000, put $20,000 into it, and then we'd have it for sale for $125,000, and then it would appraise for $95,000. And it was because all the comps that were there to look at were predominantly orange. They were lender-owned properties and they were vacant. And it's one of the reasons we had a gentleman named Magsy Arias come to be on our radio show. He was the president of the Appraisal Institute, trying to figure out, okay, how do we make sense of this? How do we get the property to appraise for what 25 people say they're willing to pay for it, and the appraisal world can't pull it off? So I'm going to end my portion just by saying, this is time to be cautious. You've got some time to make some decisions. My timer just went off. So you have some time to make some decisions, and it might be good to do that.